Good afternoon and welcome to the BEEKS Financial Cloud Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Gordon MacArthur, CEO. Good afternoon, sir.
Thanks, Lily, and good afternoon, folks. So I'm going to do the first part of the presentation, then Fraser will go through some of the numbers, and we've got some Q&A already submitted, so we'll tackle that at the end. So can we go to slide 3? So what I wanted to do today was just kind of start with a very high level on the period, and then recap primarily our product set, because it has evolved over the last few years. So I'm going to spend some time there. So I think just to high level cover the financials of the period. So net revenue was up 35% year on year. At 10.4 million, also 35% up on our annual committed run rate, which is one of the key metrics we use to measure where we are in the business. So as of the 1st of January, we had 21.3 million committed. That grows every month, right, on an ongoing basis. So we've progressed that over the last couple of months as well. And then our EBITDA was up substantially, 48% at 3.5 million for the period. So we've been talking to a lot of our institutional investors over the last few days, and we put it down as a solid set of numbers. I think if you look at historically how we've grown since we IPO'd, we're fairly consistent in that we're around 30 to 35%. Every 6-month period, and we've managed to maintain that. So pleased with that, and as I say, we put them down as a solid set of results. So what I want to do is just spend a little bit of time now on some of the products, the product line, and really talk about how that has evolved over the period. So can we go to slide 5, please? And going back to when we IPO'd, the business primarily was a public cloud provider, right? And what do we mean by that? Public cloud is the ability to go in over the internet and buy and consume compute and connectivity services. So when we IPO'd, had about 8 or 9 data centers, I think, from memory. The financial services data centers around the world, and people would consume our services over the internet, managed by a portal, and they would buy compute and connectivity. And we still do that. It is now a very small percentage part of the business, I think about £1 million. So, it is what we call the legacy business. And we still do it. The second part is, and that was smaller clients, right? £1,000 a month type of transaction, month-to-month commitment. Consume, as you use type of service. Shortly after IPO, we started to get more into private cloud provision, right? So private cloud is a little bit more bespoke, right? So we would work with a client who would have a set of requirements. We would go and build that infrastructure. It tended to be dedicated hardware, so servers or dedicated virtual machine clusters, and a level of shared networking. Sometimes their own networking, but more often than not, they would share all of our cross connects and connectivity footprint. So a bit of a hybrid type solution, some hardware dedicated to them and some shared environments. And really that's been the growth engine of the business over the last 3 to 4 years. Even in the last period, the 35% growth came from that mid-market, deal sizes anywhere between, £3,000 or £4,000 a month, up to some really big ones, right? Our biggest ever private cloud deal, I think, we announced last year, was about £4 million of commitment, right? So these these private cloud deals can be very small or very large, and there's quite a lot of them. So that really has been the growth engine behind the business for the last few years. For anyone that's been following us, you'll know that we made some major product announcements that started around 2 years ago, where we built out what we call Proximity Cloud. So the challenge with public and private is, if you're a tier 1 organization, a big bank, an exchange, a broker, public and private cloud deployments happened in the BEEKS spaces, right? So we would go and buy space from data centers, exchange data centers, Equinix, Digital Beam, whoever it was, and we would roll out that platform, be serviced by our on-site engineers. We would support it with our NOC, we would build it, we would support it, we would manage it. That is an uncomfortable situation for security and compliance teams and a lot of these tier 1 accounts. And we kept coming up against the same objections, the ability to plug in and download data and all that nice stuff. Now there's controls you can put around it, but ultimately the security challenges stopped us winning some business in the tier 1 space. So we went and started building Proximity Cloud, which we launched 18 to 24 months ago, where Proximity Cloud is a pre-built environment in a physical data center rack. It can be one rack, it can be multiple racks. And the key differential is can be delivered to a customer site. So the customer takes title of the environment, they can put it in their own data center space anywhere in the world. It doesn't have to be a BEEKS data center. We can host it if clients wanted us to do, but mostly people wanted to put it in their own space and various exchange data centers or financial services data centers. And that then allowed them to manage it physically with their own staff. It sat under their own network security models and can go through all the process and procedure that their own internal departments mandated. So Proximity Cloud is aimed at a single organization, right? A bank, a broker, an investment manager. When we launched the product, we had been kind of talking to a number of exchanges about the idea of it, and from the discussions, we found a rich vein of opportunity where we built Exchange Cloud. So Exchange Cloud is an iteration of Proximity Cloud, and I'm going to spend a bit of time on Exchange Cloud today. So Exchange Cloud is the same principle and model as Proximity Cloud, i.e. we physically hand over racks of cloud environment to an end client. But Exchange Cloud is built to be multi-homed. So rather than it being used for a single individual entity, Exchange Cloud has the ability to have multiple organizations on the same physical cab infrastructure in a very secure manner that allows people to have small parts of that rack, or indeed they can have their own racks, multiple racks, but the flexibility and the security is there so that an exchange can break up that environment and give it to multiple clients. So we now have basically 3 product lines: public cloud, small, not going to grow that much; private cloud, huge part of the revenue base; and then Proximity Exchange Cloud, which is the new product generations that we've put considerable investment in over the last couple of years, and we really see as the future of the company going forward. So just to go back to slide 4, Fraser, just quickly cover the map. So apologies for jumping around here, but for those of us that have followed us for a while, you'll be well aware of this map. This is our current data center footprint for our public and private cloud deployments, right? So I think we're up to around 26 data centers globally now. London is by far the biggest footprint we have, followed by New York. So as you can see from the map, we've got a good geographical coverage now. We are looking at further expansion in Canada. We are going to do something in South America, and Africa is a region that we're tackling this year as well. So once you put these in place, that public and private cloud deployment capability is fairly well globally distributed. I would not expect us to have a huge amount of new physical data center footprints, new data center locations going forward. These will now grow rather than be concentrating on deploying into new regions, because we've got a fair amount of geographical coverage. So we're going to go to slide 6, please, Fraser. So Exchange Cloud. So I wanted to give you just an update on that product roadmap. But I think by far the most exciting opportunity the business has at the moment, and really has ever had, is the Exchange Cloud opportunity. So all of the large equity stock exchanges, and BEEKS really have never had an equity play, right? We've always been in FX, some level of derivatives, but we never did equities purely because the cost of doing it was very prohibitive. You have to be a service provider in equity space, you had to take space in equity data centers. You kind of had to do them all at one go. The exchanges charged you 20 to 30K a month to resell that market data. You start multiplying that by 10 and 20 times, as well as the cost of the environments. It was a £5 to £10 million commitment for us to make that equity cloud offering a reality, which we just never did, because we would have to build it and then they would come, and it was going to be a real drag on the business. So Exchange Cloud opens up an equity opportunity, the equity space opportunity for us in a fairly unique way. So all of the large stock exchanges or equity exchanges around the world tend to have their own data centers, right? So you look at NYSE and NASDAQ in the US, they've got Carteret, Mahwah. LSEG have just moved a data center out of Earl Street into actually a third-party data center, but it's still theirs. They offer that as a service. So all of these big equity exchanges have their own infrastructure in the data center, but the bigger part of that is the end customers will also put their own infrastructure in that data center. So you look at a NYSE or a NASDAQ, they have 800 to 1,000 cabinets of customer equipment connecting into the matching engines for various reasons, right? HFTs, banks, brokers, technology providers, market data providers, news providers, all have to have physical footprints in these stock exchange data centers. So there has never been a cloud service that has been available, right? You can't put it up on an AWS or a GCP if it's a latency sensitive environment. And the only reason you would be in these data centers is if latency is important to you. So previously customers had to build out the environments themselves. Some will continue to do that. But what Exchange Cloud gives the exchanges now is the ability to offer a cloud service in their home data center, right? So the model is we sell to the exchange, we have one customer, one contract, and then the exchange offers the cloud service out to their user base under their existing contract terms. So it's a value add service from the exchanges to the customer base. Why is it important? It reduces the barrier to entry, right? It allows some of the smaller firms who maybe couldn't afford to do full racks and all of these data centers around the world, like us, the ability to buy a cloud service that can start from a few thousand dollars a month for a full network, compute, and analytics stack already pre-built. It's quicker time to market, so rather than, especially with all the supply chain issues at the moment, we pre-build the racks, they're sitting there ready to go, the exchange can turn clients up, in the matter of hours, rather than waiting weeks and months for them to build out their own environment. So The BEEKS Exchange Cloud offering has been licensed by ICE Global Networks. So we announced that last year. They were our kind of launch partner. They kind of did a bit of product development with us. So they're the largest exchange group in the world. So ICE Global Networks are part of the ICE group, and they're a service provider for lots of financial markets participants around the world. And they are licensed. They have licensed Exchange Cloud for their end users. So that was a big announcement for us. As we said on Monday, we are very close to the next two exchanges signing their contracts. We've gone through very long sales cycles with both of them. One's a regional exchange, one's a major exchange. We'd hoped one would have been signed before Monday, but it didn't happen. So we've got a pipeline of other exchanges coming online, and the two that are fairly far down the line are not by any stretch of the imagination the last ones to sign up. So the reason it's exciting is the size of the opportunity, right? We license it on a per cabinet basis. So each cabinet is roughly worth $1 million of TCV to us as BEEKS. The client then resells that one to their end users. So $1 million TCV per cabinet. If you look at some of these big exchanges, as I said, they have up to 1,000 cabinets of customer equipment in their data center. Now, as we've gone through all the institutional investors, we're not saying, that we are going to get 1,000 cabinets. That will never happen. There will be people that continue to do this themselves, prefer it. That's the way they want to go. But can we get, 5 to 10% of that total addressable market per exchange? That's really our hope, right? So as we get more and more exchanges on board, our land and expand strategy that we've always had with these tier 1 clients comes into play, where they're not going to start with 50 to 100 cabs, maybe 2, maybe 5, maybe 10, but we fully expect as they fill up, then the follow-on orders to be substantial. So it's a really nice space that we've carved for ourselves. It's not particularly competitive because there's no other provider out there that has a product like we do. So Exchange Cloud really is where we go from, I think the forecast of the market for next year is 30 million, but it's where we kick on that growth. I mean, we've gone from 3 to 30 since we've IPO'd, if we get to 30 next year. To get to the next stages of growth, Exchange Cloud really is our flagship product that we hope will get us there over the next few years. So it's an exciting time. Fraser's going to cover some of the commercials. Spent a lot of money building it out, both from a software development point of view, infrastructure, buying and holding stock that we now need to do because of supply chain issues. So it's been a big investment for us, and we're now hoping that the returns flow over the next couple of years. Cover the numbers.
Yep. Thanks, Gordon. Numbers update, relatively short, short and simple. I can see there's quite a few questions at the end that we'll cover in terms of some specifics. But as Gordon says, we've had another consistent period, and as he said, 5 years since we've IPO, we've kind of tended to deliver 30-35% top line growth. So again, another pleasing period, and a lot of that has been our core business. So our private cloud business has delivered that. So the kind of small deal run rate type deals that have kept it going during the period. Gordon's talked about proximity and Exchange Cloud. So in terms of the second half, there's an expectation in terms of where those contracts are that they will deliver into the second half. But it's good to have that first period just with the run rate business, and that's why the committed revenue, so ACMRR, so annualized committed, so that's effectively on the books revenue, is also 35%, which is good. So if you look at our full year number, which is consensus just under 25, we've got about 85% of that already committed. And in terms of how that's translated to the profit numbers, so profit before tax and EBITDA both up over 40%. So we are delivering on that top line growth. We're always going to be second half weighted on that recurring revenue model. So in terms of some of the margins, if you look at period on period, there's a slight increase in gross profit margin, which again is pleasing. Key driver for that, Exchange Cloud, Procs Cloud sales in previous periods. So that is a slightly lower cost of sale to us. So the kind of lag in the previous period on Procs Cloud sales has helped that percentage margin, which is good. In terms of cash, so we've talked quite a bit to our institutional investors in terms of our operating cash flow, where it's at now and where we expect to see that. So, from an operating cash point of view, again, we've grown it in the period. We are still at a net cash outflow over the period, so just over 3 million. We strengthened our balance sheet back in April, took a raise of 15 million, so we're in a much better place. As we move into the second half, again, we expect stronger operating cash flows with a similar level of investment. So as we move sort of forward over the next kind of 12 to 18 months, we expect to see that get into a cash generating phase, right? So we've talked again, as I say, quite a bit about this. When as investors, you expect to see a return on that investment, right? As Gordon says, with the last couple of years, we've added a lot to our headcount. We've invested capacity. You've got quite a bit of stock sitting, just over 2 million sitting in our head office. So as we move into the next phase, we will control our headcount again. Maybe sometimes over elaborate that point, but that's the kind of key lever for us to manage our overall profitability and our cash generation. And we've kind of been through that product recruitment in the team, so we're kind of largely there with that. So headcount will be incremental as we move forward, and we've got a bit of scope to eke out an extra percentage or two in terms of overall profit margins, and controlling the headcount will allow us to do that. So that's certainly the focus on the business over the next 12 to 18 months.
Okay, next slide. So 2023 objectives. So we kind of have internal the year of, right? So a few years ago it was the year of people, right? Trying to start to get that, building the team to build out, where we wanted to go. So we've kind of done the year of people, the year of product, where we started, and did a lot of proximity Exchange Cloud build out. This year, going forward, 2023 is really, we're looking at the year of profit, right? We've, as Fraser says, we are now at a stage where we want to start to become cash generative, and that the statutory numbers to be above the line. So this year we're looking at to do that, we need to convert the pipeline that we've got, right? We've got some very slow moving but very significant opportunities on the books. Getting them closed, deployed, and doing them sensibly with sensible cash flow implications to the business are really important to us going forward. So that's primarily the number one focus, and that will drive a lot of the top line growth, but also allow it to fall to the bottom line. So we will continue to build out the products. A lot of the heavy lifting has been done, but as we work with more and more exchanges and more banks and brokers on the proximity cloud, requirements come in as we have these discussions. So there is still product roadmap there, and we've got feature function we want to build out for the next 12, 18, 24 months. We have a very strategic relationship with IPC. We jointly go to market with them. We jointly bid in a lot of stuff. They're a customer of ours, we're a customer of theirs. So we want to continue that momentum. It's been a real benefit to both organisations when you combine their networking product with their infrastructure product. Some of the Exchange Cloud conversations we have are jointly with IPC, going to the exchange with an end-to-end solution that is an infrastructure in your data centre. But IPC also have network connectivity all around the world that trading organisations need to send market data around the world. So we continue to grow that relationship, and it's been a real benefit for both organisations. And then, our return on investment, right, the year of profit. So focusing on that bottom line is important for the year. Next slide, Fraser. So outlook. Really positive. I think we have a range of products now that I'm really happy with. Right, the team have done a fantastic job. Product strategy people, development people, everyone in the organisation has contributed to building out market-leading products that don't have a huge amount of competitive push on them. So it's put us in a very good position. So the pipeline is very strong. Frustratingly slow moving. Exchanges are very highly regulated entities, as are the big banks. So they do not do anything quickly, purely because they're very large, they're very regulated. These are big decisions. If you look at Exchange Cloud, an exchange is basically offering it as a service. It's their name on it. It's powered by BEEKS, but it's ultimately their service offering. So they have to go through a huge technical due diligence, operational due diligence exercise. It just takes time. So the move to the cloud and capital markets is increasing. There has been quite a lot of big announcements of the hyperscalers and exchanges. Not really in the trading infrastructure side, more desktop, back office, the execution component. I fully believe that the future of exchanges is going to be a hybrid cloud footprint where they have matching engines, physical matching engines that people can connect to, and then some workloads live in the hyperscaler generic clouds. Back office fits in it very nicely. Market data is very well distributed by the hyperscalers, but there's still no answer to how do they do that execution engine, and that's really how we surround that physical execution footprint with our cloud offering. So we are cloud enabling the end users of that area. So our world is becoming more and more cloud, accepting of cloud platforms in various parts of their organization. As we mentioned on Monday, we've got 2 deals, Exchange Cloud. I think that we are looking to close out in relative short order. I think the good thing about some of these big engagements is that it's high quality pipeline, right? We go on a journey with an exchange that can last up to a year or 2 years, but it's a significant investment in time and effort from them, because this touches a lot at most departments within the exchange. So we have to deal. We're not just selling to IT. We're talking to security. We're talking to compliance. We're talking to business dev, accounting, support teams. So we can tell when they it's high quality. It's not like they're having a bake-off between us and someone else. We go through a journey and an education with them, and it kind of if they're going to do that and put the resources in it, it's more when it happens rather than if. So we were always historically used to very short lead times on deals closing. We're in the opposite side now. We still have that small deal engine that will continue to find and close deals in a couple of weeks, but we also now layer on top these bigger transactions that we are monitoring as a pipeline from very far away. So and the pipeline is bigger than ever with a lot of these tier 1 customers. And once we win them, the land and expand opportunity is hugely significant. The second deals after the first deal is much easier, as is the third and the fourth. So we've shown from some of our tier 1 wins where we are 500-600% of our original contract value a couple of years into the relationship, that we're really good at doing that. So we will continue to do it. So the outlook is very positive. We look to close out the year, get these 2 exchanges onboarded with contracts, and continue to increase and convert that proximity exchange cloud pipeline and continue the small deal run rate in private cloud. So it's an exciting time and an interesting time for the business and everyone involved. So I think there's quite a few questions. Do you want to scroll to the top? So we'll kind of start to go through some of the Q&A. Yes. How is the productivity? So Mark's asked, how is the productivity of the software development team? So we, 3 or 4 years ago, we were 95% an infrastructure company, right? That has changed dramatically over the last few years as we've grown a software dev team to build out the product, right? The product is half infrastructure, half software, right? We're basically selling big appliances, right? Software bundled onto hardware platforms. So we've had to build out that software development function from historically not being a software development shop, right? We had a couple of developers, but to scale that is hard, right? It's difficult. So it's been a bit of a challenge over the last few years. We've now got a team that we're really comfortable with, who are managing that process. I would always say software developers can work a little bit, harder, deliver a bit faster, but they are a certain breed of individual, and overall, I think we've got a lot better. I think we could squeeze a little bit more out of them. Yes, I do, but I'm not sure. I'm not sure if the head of software development would agree with me or not. Do we need more people in the software development team? No. We, as Fraser says, we have invested significantly. I think we're about 40. Yeah, 40 people in that software development function. That will not, we might take a couple of incremental people for specific roles, but that we don't expect that growth in the headcount yet to continue. It will tail off.
I'll maybe take the next one. So next one, cost of data. Cost of data centers are rising significantly. How do you experience it? Can you pass on those costs to your existing customers? So yeah, they are. So we got fairly chunky price increases effective 1st of January. The quantum was about £1 million to our cost base. We have always done an annual price increase. So we effectively hedged that cost increase. So we gave customers a bigger inflationary price increase. We weren't profiteering from that. We were simply passing on the cost to do business. So that's effective from 1st of March. So just a couple of days ago. So we kind of took a bit of pain in the first half, but that price increase is effective from March. So we'll kick in the second half. Next one, I think, is similar. Talks about managing the wider inflation impacts. Yeah, so things like as well as power increase, wage inflation. We were subject to that. We gave reasonably fair, decent pay increases across the board. But again, that price increased our customer factor, both the power increase and the cost of wage inflation in there as well. I think that the other question on that is around. So somebody's said that the sales are now 2% lower in comparison with the 30th of June 22. So I think what's been asked there. So if you look at our first half, we've done 10.4 revenue. If you take our full year number for last year, it was 18.3. If you take off our H1, it was 7.7. So actually H2 last year was slightly higher. It was 10.6 compared to the 10.4. The main reason for that, so we've always had this underlying recurring revenue nice profile. We proximity and exchange cloud are a different revenue recognition model. So when we deliver those appliances to customers' data center, we have to recognize about half of that upfront, right? So what you're seeing there is that half upfront as part of last year's number, right? The upfront revenue recognition. If you're comparing it year on year, we'd expect to do pretty similar this year, and as we've said, so we've grown the run rate 35% as well. So you can almost need to look at it at a full year comparison, I think, rather than half years. But that's really what's driven that. Again, I think similar to revenue. So talking about our progressive has a 24.5 million revenue forecast. Is this revenue still achievable? Yeah, we absolutely believe that. So looking at where we are in terms of run rate. So the exit revenue in December was 21.3. That excluded the price increase. So that'll kick in. And in terms of that visible pipeline that's short term, we do expect to deliver a proportion of that before the year end, and that will allow us to get to the consensus forecast. No, for me. I suppose I didn't do much talking at the start. So, okay, when do you think the cost base is stable, and how much revenue do you need when the profits are kicking in? I think, again, we've, depending on the profitability metric, right? So, we're aware the statutory number is loss making. If you take the share-based payment as a non-cash add back, we are profitable. I think in terms of cost base stable, so the way we price deals is a cost plus margin, right? So we've got that visibility. I think, as I said earlier on, it's really for us, writing good business and controlling headcount is really how we deliver, better profitability going forward. And a lot of that is in our control. And as a board, as a management team, we believe we can deliver that. And in terms of time frame, we're looking to do now, right? So I think, as I said earlier on, so 12 to 18 months to really kind of focus on better margin and better cash generations is probably the timescales that we're working to. Again, similar, it's talking about cash outflow. So in the period, as I mentioned earlier on, the cash outflow was 3.5 million. The cash reserve just now in our balance sheet is just under 7 million. And the question is really, what's the view in terms of, further raises? Short term, no. In terms of what we need to deliver the consensus forecast, we have enough firepower in terms of additional debt that we can take. We took some asset finance in the period of 1.5 million. We have access to more, and we have revolving credit facilities available from our bank. So, we probably believe we've got enough cash in the bank and access to debt in the short-term future. Would we rule out a return to market? No. On a mega deal coming back to the market, with a deal that we may have to front load some cash, then possibly, but be on the back of a major contract win. Okay, so Nick B, what further investment is needed into the business over the next year, and where are you looking to use that investment? So I think the product investment is largely we've made over the last couple of years, and that development team is built. So that will be kind of adding as we go forward. That major investment we feel is now made. We're always we always have a cost of doing business, so capacity we will always have to invest in. Supply chain issues mean that we have to hold more on our balance sheet just now, so the stock we have is a couple of £1 million worth. Going forward, as those supply chain issues shorten, we would not expect to hold that kind of level of stock. But in terms of investment, I think, Gordon, correct me here, that we kind of gone through that major cycle for the last couple of years, and now it's really a case of execution and delivery on some of these wins.
Yeah, I think Fraser's right. I think we still have to have the level of software team, because there's still feature function to build out. But in terms of a percentage of our revenue and things like that, then the headcount will tail off over the next year to 2 years. So we will still invest in the product and try to pivot the organisation as we need to, but a lot of that is done. So just going on to some of the next ones, as NICE, you're looking to sell Exchange Cloud to existing customers or just new customers. So need to be clear here. So NICE is a stock market, right? New York Stock Exchange is part of the ICE group, right? ICE Global Networks have licensed our platform, and they are looking to sell it to both new and existing customers. Yes. Next question, when the 2 Exchange Cloud contracts are completed, is there a large CapEx implication? It's the same as anything, right? We have about half of the stock available in Glasgow to facilitate the initial 2 deployments to the 2 exchanges. So we will have to commission some more new infrastructure and backfill what we have if the supply chains are still looking stretched. So yeah, there's CapEx implications to every exchange in Proximity Cloud we do, because we have to deliver a substantial infrastructure every time we deliver a cap. So it's just part and parcel of the way we do business. So can we run through the revenue potential for an Exchange Cloud customer win? So that's a good question. So like we kind of separate them into medium and large exchanges really. So if you take the top 10 exchanges globally, if we win one of them, my view is that our opportunity is north of 20 million TCV per exchange. Now, that's not going to happen all on day one, but if you think it's $1 million per cab, should we be at least getting 20 cabs over a period? If their sales team push it and it's successful, then absolutely, yeah. How big does it get? I don't know. It's hard to tell. The next two are going to be real tests of how quickly this grows. I think the first one and maybe a bit smaller, they have done a very good job of going around a lot of their customers and demoing the platform as they've gone through the contractual process with us, and the uptake has been higher than we would have hoped. So we've got high hopes that actually they'd fill up very quickly, and then we go on to phase 2, 3, 4, 5 of the deal. But it's hard to tell. Are there any Exchange Cloud contract wins included in the consensus estimates? We probably have to get revenue recognised from the smaller one, but we are not counting on the bigger transaction hitting the books this side of the end of June, which is our financial year end.
Next one, how well do your depreciation rates match the life expectancy of your kits? So, we depreciate over 5 years, and we get a bit more out of that. We don't, if you think of our life cycle replacement, we've not had a major, refreshment, but we're going to start having to do that. So, I think it's fair to say we get what we depreciate, or, we get a wee bit more, but we don't push it too much. Can the CFO give more clarity in note 3 to the accounts under the heading operating segments to show proximity Exchange Cloud revenue amounting to 50% of the total? Yeah, so the way we disclose that in the accounts, so we have what's called point in time and point over time. So if you look at the full year to 30th of June 22, the 2.2 million point in time revenue that you see as part of that number is the 50% upfront, right? So as we deliver that into customer data center, we can recognize half of that, right? So and then the remaining 50% we take over the contract length, and that will be in between sort of 3 to 5 years. So again, if you look at the first period that we've just covered, you'll see there's point over time proximity cloud revenue, and that's that maintenance revenue, which is the remainder of the contract flowing through.
So are there opportunities to upsell additional pure software features? So that's again a good question. So we acquired an analytics company 2.5 years ago now, Velocimetrics. What we've done is built in, and a big piece of development effort over the last 12 months has been building in that analytics function into Proximity and Exchange Cloud. So when we sell that to a customer, they have inbuilt analytics via the UI of Exchange Cloud. Major piece of work. So that's a software component, but it now just becomes a component of the Proximity and Exchange Cloud sale. And Exchange Cloud, the exchange will then go on and sell that as a bit of a software play to their end customers and license it per server or however they want to do it. So we're rather than kind of coming up with software offerings, everything will be built as component parts to Proximity and Exchange. It just makes life simpler, right? And maybe customers can license different bits as we go forward. So we're not really looking to become a pure software play. Everything will be, integrated into that pre-engineered systems. Next question, do you anticipate new institutional investors coming aboard? We did the equity raise last year. It was heavily oversubscribed. We had a number of new institutions. Artemis took a substantial shareholding. Saracen, so we've had you know, when we IPO'd, I think we had maybe 4 or 5, you know, the larger institutional investors that bought us on day one. They you know, pretty much every time we've needed to go for money, they've increased their holdings. So we got a really stable base of institutional investors. Some new ones came in. You know, it's hard to say. You know, we try and kind of limit the investor roadshow, or we could spend our entire life in London talking to fund managers rather than running the business. So it's a difficult question to answer. And you know, existing shareholders might add or, you know, do what they want. So it's a difficult one to answer. I do not know. Final question is, how many exchange-led customers on the sales pipeline to crystallise over the next 2 years? I'm going to set myself a target to be hung on here. So I mean, listen, I would hope to sign 4 or 5 of the majors, and then another, you know, 4 or 5 of some of the smaller exchanges over the next 2 to 3 years. The sales cycles are very long, right? They're very long. But as we become, you know, as more exchanges do it, then it becomes a self-fulfilling prophecy, right? You know, the other exchanges just look at it as, then, you know, why are they not offering this service to the clients? So, yeah, anywhere between 5 to 10 over the next 2 to 3 years, we would hope.
I think one we've missed there. So the question is asking what kind of level of maintenance capex profile is envisaged. You know, I think so for the different propositions. So I think proximity and exchange, you know, will be 4 to 5 or 3 to 5 year deals. So that'll be a recycle after that period. And I think, you know, our historic private and public cloud, you know, I would assume, you know, are similar to how we depreciate. So over 5 years, you know, if you look at our estimate in terms of fixed asset spend in the year, it's about 6 million. Of that, you know, historically, you know, it was lower. So, you know, probably around 10% of that would be, you know, maintenance, replacement, and the rest on growth.
All right, folks. Well, that's
Gordon, Fraser, thank you. And I think you've addressed all those questions you can from investors. And of course, the company will review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, Gordon, could I please just ask you for a few closing comments?
Yeah, so thanks again, Lily. So yeah, I mean, I think it's been a strong period again. We now have a track record of consistent growth. You know, the company's gone from, you know, 3 million turnover to where we are now over the period of time we've been on the market. And we look forward to an even more exciting growth trajectory going forward. So it's a really interesting, exciting time for everyone involved with the company. And, you know, we thank our shareholders for their loyalty and continuing to support the business. So, yeah, thank you.
Gordon, Fraser, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of BEEKS Financial Cloud Group PLC, we'd like to thank you for attending today's presentation. Good afternoon to you all.